I'm Daryl Jones, Director of Research at Hedgeye. I'm joined with Hesham Shaaban, who's our internet analyst. We're here to talk about Yelp, one of our best ideas on the short side. We've had it as a best idea since April. Stock's down about 40%. We see more downside. Part of that's based on some new information that Hesham has.
Yeah, so right now it looks like management is getting a little bit more desperate. They're starting to tinker around with their key operating metrics, and they're making some highly questionable acquisitions, while at the same time there's a good chance that they're understating the implied revenue contribution from these acquisitions in order to make its core business look better.
So the rationale behind all these actions from management is basically that the core business, I guess, is in decline.
So the core business is under serious pressure, and Yelp's business model, in a nutshell, is that they need to drive new account growth in excess of their rampant attrition in order to drive its growth. And what's happening right now, what we can see in their reported data, is that Yelp is now struggling to drive new account growth in excess of the rate that they're hiring sales reps. So when you have a massive attrition problem, that is a big deal. So what Yelp is doing right now, we'll just start with the first point, they have reclassified its reservation service that it acquired in 2013 as an advertising business, which doesn't really make a ton of sense. I mean, any way you want to look at it. The other thing is they're pulling their legacy account metric in favor of a new one. So the question is, well, why can't you provide both? And we believe the reason why is because one of their key metrics that they report, its customer repeat rate, is what we use to back into its account mix and in turn figure out what's going on with its attrition. By pulling the legacy metric, management is buying themselves some deniability because now we have an apples to orange comparison. And then on the third point, on the acquisition side, right after the 2015 guidance release, Yelp made one of its bigger acquisitions within its history. Now, there is a rumor across the street that Yelp may have understated the implied revenue benefit by up to 50%. And from what we have found is that the implied guidance raise from that acquisition of $36 million is actually less than what E24 was expected to make in 2013.
So the implication of that could be that numbers in the short term look good, stock could pop, but
Absolutely.
You'd look through that, you'd probably look at that as an opportunity to short, and then play it out 12 months from now, 18 months from now. What is the downside in the stock? Like where can the stock go from?
So I think Yelp's going to trade into the mid-30s by this time this year, by this time next year. And I think the ultimate problem is that Yelp is really just kicking the can. Because at the end of the day, they may be able to fool some people on the street on the 1Q print. But what happens after that is the sell side raises estimates, and they continually raise estimates, and they continually weight their estimate raises towards the back half of the year or towards the following year. So what happens is Yelp is going to get to a point where they can't issue quarterly guidance or raise 2015 guidance in excess of what the street is looking for. And when that happens, which is what we saw in this most recent, what we saw last year, the stock's going to crumble.
So expectations are the root of all heartache as usual.
Exactly.
Great. Well, I'm here with Hesham Shaaban. I'm Daryl Jones, Director of Research at Hedgeye. Yelp on our best ideas shortlist. We still think it's a short. We think by next year it's going to be in the mid-30s. Could be some volatility in the short term, but we definitely think it's one to keep on the short side of your ledger. Thanks.